Hello guys, today I'll be discussing a term called arbitrage. Arbitrage is a concept in finance. Let's understand it closely. What is arbitrage? Arbitrage is a simultaneous purchase and sale of the same or similar asset in different markets in order to profit from tiny differences in the asset's listed price. Arbitrage is often called riskless profit because it's a riskless activity. Traders are buying and selling the same asset simultaneously and pocketing the price difference as profit. To comprehend arbitrage better, let's look at a simple example. The stock of company X is trading at $20 on the New York Stock Exchange, while at the same moment it is trading for $20.05 on the London Stock Exchange. A trader can buy the stock on the NYSE and immediately sell the same shares on the LSE, earning a profit of 5 cents per share. In this situation, the trader can continue to exploit this arbitrage until the specialist on the NYSE run out of inventory of company X's stock, or until the specialist on the NYSE or LSE adjusts the prices to wipe out the opportunity. Arbitrage has certain types. Let's understand them one by one. Pure arbitrage. In pure arbitrage, the arbitrager makes a buy or sells decision right away without having to wait for funds to clear. Retail arbitrage. This is a popular e-commerce activity. Arbitragers buy a product at a low price from a local merchant and then offer it for a high price on an e-commerce website. Risk arbitrage. Here, investors frequently forecast a stock's price rise and, as a result, buy and hold the stock. In other words, investors are anticipating a price increase in another market. Convertible arbitrage. In convertible arbitrage, arbitragers profit from holding a long position in convertible securities while simultaneously shorting the underlying stock. Merger arbitrage. This is a tactical endeavor. When arbitragers suspect an acquisition or merger, they purchase a target company's stock. They sell the shares when the prices rise after the merger. Dividend arbitrage. In dividend arbitrage, traders that use this strategy buy stocks immediately before the ex-dividend date. The ex-dividend date is a deadline for completing the purchase of the underlying stock by the investor. He is only then entitled to the payout on the specified date. Future arbitrage. In future arbitrage, the stock is bought with cash and then sold in the futures market. Futures are usually priced higher than cash to account for the future premium. On expiry, however, both prices converge, giving the trader an arbitrage profit. Let's look at some of the benefits offered by arbitrage. Arbitrage helps in keeping prices of securities across different markets more or less in sync with gaps just explained by differential transaction costs. Therefore, you can say that arbitrage helps in better price discovery of an asset and also virtually eliminates price variances across different markets. Arbitrage helps in making the financial markets more efficient and robust. It makes markets more liquid as it invites institutional participation and the use of sophisticated technology. Risks of arbitrage. Although it is considered a risk-free trade, it is prone to various shortcomings. Market uncertainty. Markets are unstable and therefore can respond opposite to expectations. Buying and selling given security in different markets can reduce spread to such an extent that arbitragers end up in losses instead of profits. Counterparty credit risk delinquency. When activities, buyers or sellers default, arbitragers encounter losses. Limited opportunities. It cannot be taken as a full-time career. With the increase in such players, the regulators start checking market inefficiency. Ultimately, loopholes are eliminated, leaving little room for arbitrage. High transaction costs. Different markets have varying transaction fees, taxation and brokerage charges. Overlooking this cost while determining the spread impacts the profitability. Requires lump sum funds. Arbitragers have to invest a huge sum to generate even a minute income. Is arbitrage trading legal? The answer to this question is yes, if you're taking stock delivery. Arbitraging is encouraged in many markets since it brings out price discrepancies and helps the market to implement the law of one price. If you like this video, then don't forget to share and subscribe. Thanks for watching.